Welcome to our channel. Today we are diving into the fascinating and complex world of the yen carry trade. On August 5th, major stock markets around the world experienced their sharpest decline in decades. While several factors contributed to this drop, one major reason was the unwinding of the yen carry trade. This video will take you through what the yen carry trade is, why its important recent developments, and its massive impact on global financial markets. Let's break it down in simple terms. Let's start by understanding what the yen carry trade actually is. The yen carry trade is an investment strategy where investors borrow money in Japan, where interest rates are exceptionally low, and invest that money in countries with higher interest rates. The goal is to profit from the difference in interest rates, also known as the interest rate differential. This strategy is named after the Japanese yen because Japan has maintained low interest rates for a prolonged period, making it an attractive source of cheap capital. Imagine you live in a country where the interest rates are very low, like Japan. You borrow money at these low rates and invest it in a country where interest rates are higher, like the United States, India, or Brazil. This way, you earn a higher return on your investment while paying minimal interest on your loan. From 2011 to 2016, the Bank of Japan BOJ kept interest rates at 0%. In 2016, the BOJ pushed interest rates even below 0 to minus 0.10%. This policy made borrowing money in Japan very cheap. Investors around the world took advantage of this by borrowing yen and investing in higher yielding assets in other countries. Understanding why the yen carry trade is important requires a look at its broader implications. Japan's ultra low interest rates provided a source of cheap capital for global investors, fueling investments across various markets and leading to increased liquidity and potentially higher asset prices. While the carry trade can be profitable, it is also risky. Currency fluctuations can quickly turn profitable trades into losing ones. For instance, if the yen strengthens significantly against other currencies, the cost of repaying yen-denominated loans increases, potentially wiping out gains from investments. Another reason the yen carry trade is important is its impact on global financial stability. When large amounts of money are borrowed in one currency and invested in others, any significant changes in interest rates or currency values can lead to rapid and large-scale movements of capital. This can create volatility in financial markets, affecting everything from stock prices to exchange rates. The yen carry trade also illustrates the interconnectedness of global economies. Changes in Japan's monetary policy can have far-reaching effects, influencing investment flows and economic conditions in other countries. Moving on to recent developments, on August 5th, major stock markets around the world experienced one of their sharpest declines in decades. Several factors contributed to this drop, including fears of a US recession and rising geopolitical tensions in West Asia. However, a major trigger was the unwinding of the yen carry trade. Recently, the Bank of Japan raised interest rates by 35 basis points, bringing the rate from minus 0.1% to 0.25%. Now, this increase, although modest in absolute terms, was substantial given Japan's long period of as the BOJ raised interest rates, the yen appreciated against other currencies. This made it more expensive for investors who had borrowed in yen to repay their loans. The appreciation of the yen reduced the value of assets held in other currencies when converted back to yen. As a result, many investors began to unwind their positions, selling off assets to repay their yen-denominated loans. This mass sell-off contributed to the sharp decline in global stock markets. The unwinding of the yen carry trade has caused significant volatility in emerging markets. Countries like Brazil, Mexico, and India, which had benefited from inflows of cheap yen, faced sudden capital outflows, leading to currency depreciation and stock market declines. The strengthening of the yen caused fluctuations in exchange rates, impacting trade and investment flows. Central banks in affected countries might need to respond to increased volatility and potential capital flight by adjusting their own interest rates or implementing other monetary measures. This event highlights the interconnectedness of global financial systems and the far-reaching effects of monetary policy changes in major economies. It underscores the importance of monitoring global financial conditions and understanding the potential ripple effects of changes in one country's economic policies. The story of the yen carry trade teaches us how a country's monetary policy can have global repercussions. Japan's small interest rate increase led to significant turmoil in global markets. As investors navigate these turbulent times, it's crucial to understand the impact of such financial strategies. Let's take a closer look at how the unwinding of the yen carry trade has impacted it. India, like many emerging markets, benefited from the inflows of cheap yen. Investors borrowed yen at low interest rates and invested in Indian assets, seeking higher returns. This influx of capital helped boost India's stock market and strengthen the rupee. However, as the Bank of Japan raised interest rates and the yen appreciated, the dynamics changed. Investors who had borrowed yen now faced higher costs to repay their loans. The appreciation of the yen meant that converting Indian rupees back to yen became more expensive. As a result, many investors began to unwind their positions, selling off Indian assets to repay their yen-denominated loans. This led to a sharp decline in the Indian stock market and depreciation of the rupee. The sudden outflow of capital created volatility in India's financial markets, prompting concerns about economic stability. The Reserve Bank of India (RBI) might need to consider measures such as adjusting interest rates or intervening in the foreign exchange market to stabilize the rupee. The situation in India illustrates the broader impact of the yen carry trade on emerging markets and underscores the importance of understanding. The yen carry trade is not a new phenomenon. It has been a part of global financial markets for decades. Understanding its historical context can provide valuable insights into its current impact and future implications. In the 1990s and early 2000s, the yen carry trade gained popularity as Japan maintained low interest rates to combat deflation and stimulate economic growth. Investors borrowed yen and invested in higher yielding assets, creating significant capital flows into emerging markets. However, the risks associated with the carry trade became evident during the global financial crisis of 2008. As markets became volatile and risk aversion increased, many investors unwound their carry trade positions, leading to massive capital outflows and exacerbating the financial turmoil. The crisis highlighted the interconnectedness of global financial systems and the potential for rapid and destabilizing capital movements. The lessons learned from the historical context of the yen carry trade are crucial for understanding its current impact. It underscores the need for robust risk management strategies, monitoring of global financial conditions, and coordinated policy responses to mitigate the risks associated with large-scale capital flows. Looking ahead, the future of the yen carry trade will depend on various factors, including Japan's monetary policy, global economic conditions, and investor sentiment. The recent developments highlight the need for careful monitoring of interest rate changes and currency movements. Investors must be aware of the risks associated with the carry trade and be prepared for potential market volatility. In conclusion, the yen carry trade is a powerful financial strategy with significant global implications. It illustrates how a country's monetary policy can impact global financial markets and the importance of understanding the interconnectedness of economies. The recent unwinding of the yen carry trade has caused turmoil in global markets, highlighting the need for careful risk management and policy coordination. As we navigate these uncertain times, understanding the mechanics and impact of the yen carry trade can provide valuable insights for investors, policymakers, and anyone interested in global finance. If you have any questions or need further clarification, please leave a comment. Don't forget to comment and subscribe for more insights into global finance and economics. Thanks for watching.